Hey everyone, it's Imran from Options Insight. This is a quick message to let you know we've got our options trading bootcamp happening this weekend, 29th and 30th of April. If you're worried about the potential recession, this is the time you want to learn how to weatherproof your portfolio. Okay, who knows where the bottom is in this thing? 3,800 on the S&P, 3,200 on the S&P. There's multiple targets out there. In this bootcamp, I teach you how to hedge your portfolio. I teach you multiple techniques, whether it's long vol, short skew. These are things you need to know how to navigate market swings. So come and check us out at our website, optionsinsight.com. This is an opportunity you don't want to miss. Back with another macro options spotlight. Okay, very quiet day yesterday. Investors kind of awaiting these mega cap tech earnings, so not too much going on. Asia was weak though overnight, particularly tech, which is weighing on markets this morning. VIX kind of drifting, not doing a whole lot, but stabilizing. Looking like the free fall in volatility may have paused for a little bit, but I wouldn't say we've got a spike yet, or even a spike starting yet. Commodities did manage to bounce from last week's losses yesterday, but they have started to roll over, led by the metals this morning. Vol does seem, like I said, Vol does seem to be stabilizing. We had US indices ticking up a little bit. European vols still lower though, and China catching a slight bid. Commodity vols were generally drifting lower. Nat gas down again, another 2 vols. That implied down to 65, lowest level we've seen in natural gas vol in quite some time. But gold vol did find a small bid. If we look over at carry, still lots of positive carry across equities. All of this green here telling you that realized just is not going up at all, right? Now that may well change as we get these mega cap tech earnings, depending on what happens. We have also got FOMC next week coming up as well. But looking at commodity carry, nat gas the only one in the red there. Rest of them all still pretty green. Gold fairly neutral. Looking at skew, we did see a pullback in skew for the most part across most indices, although S&P skew still holding relatively flat and keeping those gains from last week as some hedging coming back in. Commodity skew, pretty boring for the most part, except uranium catching a slight bid there, and we saw gold slightly offered. Okay, what else are we looking at? Market breadth looking pretty shocking right now. So Morgan Stanley Research put out a piece, put out charts saying how bad market breadth is, lowest that they've seen since 2005. So it's pretty shocking there. And we have been flagging that, right? All of this market strength has really been centered around a very small collective of mega cap tech names. Mike Wilson obviously has been one of the loudest bears for a while, saying that in these sort of underlying conditions, he can't really see how a new bull market is going to begin. These are not typical conditions for that to happen, looking back at history. We do think a large part of the sort of broader market resilience has been due to these systematic flows that we've been talking about. We had vol obviously compressing into that seasonally quiet period of Easter. When that happens, we know that short dated vol below 10% drives the vol control guys to come in and buy equities. So we see here, if we look at the implied notional flows from this lower volatility, they've been driving higher. So we've seen length being added back by these vol control guys. That's been keeping the market relatively resilient. Similar story with CTAs who've been adding length as well. But let's look at the vol. The 1 month realized vol collapsing there below the 3 month. But how low can this go, right? It's very unlikely for this 1 month realized to go below 5. So it's kind of running out of room on the downside. Okay. So as it runs out of room on the downside, or even if it just stays where it is, then there's no incremental buying that needs to be done. So I would say that we are sort of running out of room, or that buying is going to slow down, or it may even turn into selling. If the vol was to bounce, then those same vol control players are just going to be selling back out their market length, right? And this is going to roll back down as the vol bounces. So it's very reflexive. So if we do have anything that makes the market sell off, then we would expect that to drive those selling flows, and that may then exacerbate the move and be a bit of a snowball. We do have Microsoft earnings kicking off, starting this mega cap tech earnings, reporting week. Obviously, there's been a rotation into these mega cap tech names. They've been considered somewhat safe havens amidst the banking crisis. So there may be some vulnerable positioning in some of these big cap tech names, right? So if they do miss, by the market's expectations, then if everyone's camped out in these names, maybe they actually can sell off materially, right? And it's not like we haven't seen it before. Just because they are mega caps, we've seen the likes of Amazon move 20% before. Facebook, we've seen 20% on earnings, right? So you never know. There could be some pretty huge moves in these things. And if these are the things that the market is parked in, then we may see a potential downside on that. We are already, speaking of downside, we are already starting to see Asia tech cracking to the downside. So we see Korean tech stocks, Hong Kong tech stocks, all starting to look quite weak. And if we plot here the Nasdaq versus the Hong Kong Hang Seng tech sector, whilst it's not perfect correlation, and there's definitely times where these things diverge, right? Historically, we've seen that, but they tend to recouple at some point, right? So the fact that we've seen this thing roll over Hong Kong tech and Nasdaq sitting up there doing nothing, is there a catch-up trade coming, right? If it's on the back of general economic weakness and consumer demand for tech dropping, right? Maybe we do see something come through on Nasdaq. Now, Jim Bianco pointed out that the majority of the S&P gain this year has been due to 8 mega cap tech stocks: Facebook, or let's call it Meta, Apple, Amazon, Netflix, Google, Microsoft, and Nvidia. So that's the majority of the gain. The other 492 stocks have basically performed worse than cash. So they've done about 1.25% on the year. This is as of last week, whereas cash has yielded you 1.29% so far. So the rest of the equity market not really doing that well. That's why we think there's downside risk on earnings for these large stocks, because they have been the last pillar of strength holding the indices up. And we've seen obviously mid-cap stocks not do well, cyclical stocks be shunned in favor of defensives to reflect a worsening economic backdrop. So we do wonder if the market is a bit vulnerable here. Okay, looking at the Nasdaq vol itself, right? If I compare the Nasdaq vol to something similar like Russell vol, those two vols right now are pretty much equal, right? So if we look at the 1 month implied volatility for at the money, that spread is currently sitting roughly at 0 or just above 0. And if we look at where it typically trades, certainly for the last year, you've had the low end at about 0 of the range and the top end at around 4 vols here, okay? There have been times where it's exited lower. For example, like the banking crisis, the mid-caps really started moving because of the regional banks, and we saw implieds flip for Russell trading over Nasdaq. And if we look at the realized, which is the bottom chart, that was even more extreme. The realized vol for Russell got to like 11 vols over the Nasdaq, but that was specific to the banking crisis. So if we kind of ignore that bit and assume that for the next 2 weeks, the banking crisis is not going to suddenly be on again, okay? I think that's fairly high probability that that's not going to be a feature of the next 2 weeks so much. And then we look at what is happening in the next 2 weeks. We've got the mega cap tech earnings, okay? The big cap tech earnings. And if we look back at previous earnings cycles over the last year, basically what you see is the realized vol on Nasdaq compared to Russell is generally around 10 vols over, okay? So that 10-day realized that happens around that earnings period where those big cap tech names report, typically Qs realizes 10 vols above IWM, which is Russell, okay? Whereas right now it's trading at 0. So if you anticipate that we're going to get a similar story where that 10-day period that captures all these big cap tech earnings does realize significantly more on Qs than it does on IWM, then this looks like a bit of a misprice right now. So I don't know whether it's where the Nasdaq vol's too cheap or Russell vol's too expensive. Maybe it's a bit of both, but it suggests to me that Nasdaq vol's looking relatively cheap. Okay, and it's something we kind of said last week where we were looking at Nasdaq upside as potentially being a play for the long gamma players. But in general, we are seeing more signs that Nasdaq vol, whilst the absolute headline number might not look so cheap compared to where it is versus other things and the kind of historic realize that we've seen around these periods, it doesn't look too bad. Okay, I will catch you all tomorrow. Cheers.